welcome to all of y'all who are joining for today's webinar. We'll be talking today on the term which is very, fancy used in the startup ecosystem, which is flipping and so-called externalization. And one destination that comes to our mind is the USA when you think of setting up your company outside India. And in one of the recent articles, Sanjeev Bikhchandani actually opposed his views, saying that, for India, it's a wealth destruction strategy to set up outside because it results in, loss of tax, revenue, and IP value as well. So today we have our panelists with us. I'll just let them introduce themselves so that we can get then started on it. Starting from Abhishek, if you could just tell us about what you do.
Sure. Thanks, Radhika. Good evening, good morning, good afternoon, depending on where you are. I'm Abhishek Goenka. I'm a tax professional, been doing tax now for more than 25 years. In the current avatar, I run a firm called Eka Advisors, which was set up about a year back. And, we focus on all things tax and, headquartered in Bangalore. And therefore, as you can imagine, with a very deep focus on startups and have dealt very extensively, Radhika, with the matter you mentioned.
Got it. And over to you, Shantanu. I know you're based out of the US and work in a law firm as a partner. Apart from that, would like to know from you.
Yeah, good morning, everybody, or good evening for you in India. I'm Shantanu Surpray. I'm a US corporate and securities lawyer focused on venture capital, private equity, M&A, and some crypto Web3 as well. I have law degrees from Oxford and Columbia Law School, and I'm licensed to practice in the US, in New York, California, and Nevada. Each state is different here. The UK as a solicitor, India as an advocate, and I'm getting licensed in Hong Kong as well. And my focus of practice is generally cross-border venture capital, including either a lot of flip transactions that Radhika mentioned earlier.
Got it. Cool. Thanks, Shantanu, for that introduction. Chandra, coming to you, why don't you tell us about how you are helping startups administer outside India?
Yeah. Good evening, everyone. Chandra this side. I work for a company called Amicorp. We are a global business services provider to assist corporates with business globalization, setting up of funds and family succession structures and various, ancillary services around running the businesses and taking care of the compliances. And we've been working in about 40 odd locations across the globe, US being one of the critical markets for us. So yeah, thank you.
Cool. Looking forward to your more insights on the US market there. But Anil, tell us about your experience as an administrator and how have you been dealing with startups so far with Bhishma?
Sure, Radhika. First of all, thank you for the opportunity to being the panelist. And hi everybody. My name is Anil. I'm co-founder of Bhishma Advisory Private Limited. We have our core offices, Bangalore, Pune, Singapore, and US. And typically what we do is exactly the seminar about cross-border structuring. Any Indian company want to go overseas and set up the business, we assist them in 25 plus jurisdictions. And US and Singapore is our core market. Thank you.
Cool. I have Divakar with me, my colleague who will be moderating the session. So getting right into it, I would like to ask Abhishek this question first and then you, Shantanu, that what are the safeguards that we need to keep in mind to, be a full-fledged US entity if we are flipping outside? Because, what happens sometimes is that you still have your business owned and controlled in India, your team sits out of here, still you have a, company set up outside India, but you're anyways taxed in India. So what is it that you need to keep in mind from a poem perspective, and how is it that you can, manage with your taxes, starting with Abhishek?
Sure, Radhika, but maybe just before I respond to that, a couple of comments as a preamble. Firstly, as you right, said that this is a very fancy word, but actually, there is nothing fancy about externalization. And I think founders and investors, for that matter, should very clearly think as to why, if at all, there is a need to externalize a business, right? And of course, I think the US is an obvious choice, but the question as to why should be a serious evaluation. I know there are a lot of well-known startups that have their headquarters in the US, but I think the last thing one should do is to say that because so-and-so did it, I need to do it myself, right? And I think while maybe a few years back, tax could have been a driver for some of these decisions. And while there are definitely some tax advantages that continue to exist in an external structure versus a domestic structure, at least in my opinion, keeping larger business imperatives should be the driver for a decision like this. And those business drivers are typically things like IP protection, preference of investors depending on the nature of business, particularly if it's in the context of sectors like the Web3 or crypto. It could also be reasons like being closer to your customers and a customer asking for a local contracting entity, and therefore tax should not really be what's driving the primary decision. So I just wanted to sort of start with that preamble. Having said so, I think from a tax perspective, there's what we call, the legal structure and then the operating structure. So your legal structure could be a US headquarters with an Indian subsidiary, but it all depends on how you operationalize this legal structure in terms of where have you housed your IP. So a typical model would be that the IP sits with a US entity and all the development is done by the Indian entity. And of course, one of the things that is very important, as you rightly said, not just the place of effective management from an overall tax perspective, but even otherwise, if one is claiming that the IP is owned by the US, there needs to be enough evidence to say and show that there is somebody in the US who is actually in the capacity to direct and control whatever development teams exist in India. Right? So you can't have this sort of structure in vacuum where just by having a postbox entity, you say that that entity is the owner just because a contract says that there is a US company that's given a contract to an Indian entity. So I think substance and operating substance needs to be the paramount consideration and not just the legal structure. Of course, POEM is very relevant because in the absence of effective management being in the US, the entire top line of the US company could be taxed in India. And also, while there is still a benefit of an external structure for investors when they exit, if they are from certain countries, again, if the POEM is not established as being outside India, then that treaty benefit also goes away. So I'll just pause here and happy to take any follow-on questions.
Yeah, so I wanted to ask you there that you mentioned that the substance requirement becomes of essence. So is there any threshold of this commercial substance test under general anti-avoidance rules specifically?
No, I don't think there is any sort of quantitative test. And I think this is, like I said, a test which is broader than even the POEM conditions, because you really need to be showing that is there somebody in the US who's able to, like I said, run the business, give the direction to the development team on the product development and so on. Now, bear in mind, Radhika, that we've actually seen externalized structures where there is a US holding company and actually there's everything from A to Z happening in India, including the ownership of the IP, right? And even the customer contracts are not externalized. Now, in that situation, the question would arise as to what was the need to set up a US company in the first place. And it could be reasons like investor preference and investor comfort. Funnily, in the current context, because the POEM guidelines don't apply to companies that have a turnover of less than 50 crores, that kind of a structure actually works better because then the POEM guidelines don't even apply and an investor from countries like Mauritius or Singapore can actually get a tax exemption at the point of exit. So again, I'd really say that there's no bright line test here. You need to understand what and why you're putting a particular structure in place and then work backwards to see where you need to create the management substance.
Understood. Coming to you, Shantanu, how is it that you see this from a legal perspective and how can the two entities, both in the US and India, tackle parallelly to avoid this clash?
Yeah, no, these are some good points I think that Abhishek made about POEM. I mean, I'm going to focus more on the US aspect. It's less of an issue on the US side. The US isn't really, US tax department isn't really concerned in the same way. If you have a US entity and you generate revenues in the US, you're going to be taxed in the US. And actually the tax rate in the US has come down. I think it's about 21%. So the corporate tax rate. So it's actually quite good from what it used to be. I think it was earlier 28%. So it's really more of this interplay between India and the US. And what I typically see is one, there's a question of POEM and where the senior management are going to be. And often, particularly in a SaaS company, I do see often, which we deal a lot with, particularly that's the, a lot of the companies who are SaaS companies, those are the reasons why they're externalized, because they do have US customers or US investors. And so for them, their senior management team is often in the US in any case. And so for them, I think they're able to more easily prove the effective management's actually in the US. And if I have venture funds also, they're more cautious about making sure that all the decisions are made in the US or outside of India for sure. The other thing that we see a lot of is service agreements between the two entities. So you have a service agreement between the US parent company and the Indian company, where the Indian company is providing services. And so that needs to be clear in terms of the services provided. And then it gets into the tax issue about transfer pricing, which some of the others on the panel here can speak more about that. But those are some of the key issues that I see generally.
But is there an issue of round tripping anywhere when you talk of a service arrangement between the India and the US entity?
Well, the round tripping is more from the perspective of sending funds out and sending the funds back to India, right? So that's, in my view, less of a concern about services. It's more about money coming out of India, going to the US and coming back to India. So we don't really see that too much. I mean, there's some initial issues in how a company gets formed in the US to not trigger round tripping. But generally, I don't really see a company sending money out of India to then send it back to India, at least in the tech space. That doesn't make a lot of sense.
Got it. Cool. And Chandler, why don't you tell us about the companies that you have incorporated in the USA and the challenges that they have faced in India? That's the reason why they've gone out and set up, right? So what are those factors that you often hear from the clients?
See, what Abhishek and Shantanu had focused initially in the conversation, the most important aspect, why do you really want to do it? I was speaking with a client last week itself who was looking to set up a US subsidiary. And then suddenly he came up with the point, what if I flip my company to the US? Now he's got an existing business running in India, whereby he's got a customer base in India, in APEC markets, and a bit of a business in the global markets as well. The trigger points, are eventually as to where the eventual business lies. Tax efficiency is important, but where the business operationalizes, that's the most critical factor. Whenever we are also looking at customers, who are looking at exploring setups in the US, a lot of them come with the mindset of setting up wholly owned subsidiaries. Vis-a-vis what used to happen, let's set up a holdco in the US and then raise money on that, and then the whole business will be run from India. So this kind of mindset is has been reducing over a period of time, whereby some of the customers who have pure intentions of running business from the US, like I can give an example of existing client of mine. They are based in the real estate business. They are raising money from investors coming from the US, passive investments. They've structured their investment in a way that they would launch different series of businesses. And by virtue of their structuring, investing through Mauritius and then coming into India to invest into specific commercial and residential projects or some other opportunities. So what is happening over here is a part of business is run from the US. A part of business is run from India. Decision making is predominantly run from the US. So that substance angle or that substance perspective is predominantly US in this case. In these kind of cases, setting up of US holdcos really work well, or technology companies where the whole idea that, I am building a product or I'm creating a service solution, whereby I have majority of my customer base. There are a lot of tech companies when you see Indian origin promoters moving into the US, how they start off the business is let's set up a holdco, with a partner of us in the US. Let's start, getting some contracts, move out for the business development, run the business partly from India in the form of the backend services, predominantly, delivering, doing critical decision making from the US. That's how this technology business or real estate projects business, these are the ones that have been really going on for us. Apart from that, the standard piece has been, a lot of Indian tech companies like, startups who've become unicorns and have enough capabilities. They are on a spree of acquiring technologies. They're looking at buying technologies, and there's a huge resource pool that is available in the US. A lot of Indian origin technical guys are based on the US, they're employing them under the US subsidiaries to, to develop the products. So this is what's really happening in the market. Be it, something which relates to manufacturing technology, something that relates to hardcore software, something that relates to fintech as well. So these have been the latest trends for us. Setting up, US holdcos is predominantly a function of, where my business is eventually run upon. Today, it happens, but it happens in specific cases where there's a proper strategy involved. And, being an administrator as well, we ourselves, when we are talking to certain prospect clients, who are looking at setting up these structures, we always ask, have you thought of it properly? That means, do you have your tax and legal opinion in place? So those kind of factors we take into consideration. So
Got
that's
it.
what we've been doing.
And Anil, I'll let you speak on this, that which sectors are you seeing more shift in when it comes to, going to the USA? Of course, tech is the base, but in tech also, which sectors predominantly do you see going more to the USA in terms of your client experience?
Mostly it's a tech, definitely whenever it's a US market. But recently we have seen, as Nakul mentioned, quite a few real estate guys. Last 4 months, we did 4 transactions with the company belong to life sciences, quite a bit pharma these days. And there has been tremendous shift. Earlier, we used to think US means core 80% is a IT market, but the trend has been changing constantly since last 3 years, what we have seen.
Okay, and you said that you have offices spread across geographies. So what demand do you get generally for? Is it for USA, Singapore, UK? Where do you get more externalization?
As per the research, basically what we read is constantly, every year, almost 3,000 only Indians or Indian corporates set up the Singapore company. And the number is almost double when it comes to US, and little bit closer to UAE and UK. So those 4 geographies constantly on the top 5. After that, Mauritius and Hong Kong does come. But as all the panelists mentioned, and I completely agree with them, the way OECD has been changing and pressing, it's not only about US with substance over form, all the jurisdictions are constantly pressing for the substance issue. That is the reason BEPS is there, economic substance is there. And we really insist on what we have seen, the client will only able to take the advantage of DTA if there is enough substance test they meet in the respective jurisdictions. So the days are over for the only intention to set up a company is to take the tax advantage. That is no longer there.
Cool. I'll let Devakar take the next question.
Sure. So my next question is to Shantanu. So we talk about IP being a very extremely valuable asset for startups. So how are the legal contracts and for the legal rights and the contract enforcement in the US compared to India or any other jurisdictions that you advise startup companies on?
Yeah, I mean, I think generally the US, there's no doubt it's a litigation-oriented society. I mean, you would have all understood that. So, here I think the law is taken very seriously, and generally things work. I mean, the courts can be clogged, but I think there's no reason to believe they won't work here. I mean, things move relatively quickly, at least as far as the world of law goes, and you can enforce actions in the US. I think it's a result-oriented and litigation-oriented society. So I think enforceability is quite good in the US for sure.
Sure, and there is no a delay that typically happens in Indian courts. So what is in US? Do you see that happen, or is it very swiftly settled? The contracts are pretty much examined in black and white, and the verdict is given in a reasonable amount of time?
Yeah, I think generally, most people would agree that the U.S. legal system is generally pretty effective, particularly in the corporate environment. And you would have seen, yesterday, in the last few days, very famous case, Twitter and Elon Musk, right? It's gone to the Delaware court almost immediately, and they've already picked the judge. Right. This is in 2 days. I mean, but this is a landmark case. But in 2 days, they know who the judge is, and it's going to proceeding very quickly, rapidly. So I mean, that level of speed is pretty impressive.
Great. So staying on with the legal system. So I have a next question is with Anil and Abhishek. How do U.S. tax laws with respect to startups compared with that of India, both in terms of taxation rates and the assessments process, with a particular focus on, are there any risks of retrospective changes in the U.S. that we often hear about in India?
So maybe if I can go first.
Please, sir.
I think at the headline rate of tax, as it was pointed out earlier, there's not a material difference. India is now down to 25%. And, if you're doing manufacturing, it goes even lower to 17%, right? I think, as you pointed out, where, India, I think, still has a lot of ground to cover is on some of the rules that are sort of made to catch larger tax evaders, but unfortunately catch in their net the startups more than they catch the larger tax evaders, right? So rules like, justifying the premium at which shares have to be issued, 3 different valuation rules having to be satisfied every time there is a secondary transaction, and all those rules going in sort of different directions in terms of the methodology. So I think it's some of those aspects relating to tax that make it cumbersome in India. And of course, then, as you said, the sort of slightly more elongated assessment process and the lack of certainty in terms of what might come out of that process. I don't think the retrospective issue is really that much of a deal breaker between the US and India anymore. I think, to be fair, that's something that's been put behind us for now. But like I said, I think it's more the nuts and bolts of really doing business, the reality of it. And maybe this winter will change everything, but most startups don't even make profits, right? So really worrying about your normal income tax is not what they're worried about. What they're worried about is the overreach of perhaps sometimes the GST authorities or some of these strange tax rules that create income for them on a deemed basis just through share issuances and other transactions. So I think that's where the US system is obviously much clearer, because if you set up an external structure, then you don't have to sit and work with complex valuation rules and sit and justify the premiums raised and so on.
But are there questions asked by the tax authorities, especially in India, for those who are receiving investments from the US holdco? How do the startups go about doing that, like justifying or are they generally done at the face value issuance in India when they invest on their US holdco entities?
Sure. So when a US holdco invests into its wholly owned India sub, that's still treated as a foreign investment, from a FEMA angle. And therefore, both from that perspective as well as from an Indian tax perspective, you still have to satisfy, all the rules and so on. But I think because it is really the parent putting money into the Indian subsidiary, it's the sole shareholder, whether you allot it at X price or 2X price or half X, is going to still be the 100% shareholder. It just takes away a little bit of the sting which you have to deal with had you been raising the capital from external investors coming in directly into India, right? Because that's when you get into things like pref, ratchets, target-based conversions, one investor having a different valuation from another investor, secondaries happening at a different price compared to primaries. Doing all of those things is a nightmare in the Indian context if you were to do it directly at the India company. Versus in a flip structure, if you did all of that, at the US level, then bringing that money back to India is very straightforward, because, it's always going to be a single shareholder as a 100% sub.
And Anil, my question to you is, from investor standpoint, investing in a US incorporated holdco generally takes away your currency risk, and most of the reporting requirements typically when you see in a cross-border investment. Are there any other benefits for the investors with regard to investment and exit when they invest in a US holdco?
Yeah, as we have seen that mostly the 2 reasons Indian companies goes overseas, mostly the startups. The first is sourcing the business, and the second one is getting the investors. So investors are very comfortable either investing on the US entity or Singapore entity. The 2 reasons, as most of the panelists mentioned, the laws are crystal clear. So there is nothing kind of like a reading between the lines, or whatever the agreement or for whatever the purpose money comes. If the money comes for X purpose, it has to be utilized for X purpose. Otherwise, you cannot. If it end up in the court, it cannot be dragged for months or years. So that is the reason even most of the founders are very particular, and they, to a certain extent, even they are afraid that they cannot misuse the money which investors have put on. That is one thing. Second thing, as we all know, investor before investing the money, they always think about is the exit route. And in the both places, the exit route is very clear. The taxation is very upfront. Even advance ruling can be obtained. So those are the most of the reasons where investor insist that or precondition is that we will invest only if you have presence in the US.
Great. And at this point, I have a couple of questions from the audience, which I'll ask panelists. There is a question from a gentleman asking, with a 5% corporate tax and ease of business across EU and the US, would Ireland be a good place if we plan on externalization? And another question is, should we take UAE as well because it does not have any income tax? So your responses to that, please.
I can take the UAE question. The second question as a first might be other panelists can take the UAE. Definitely, till now there is no corporate tax, but anyhow we all must be following the news. Is that UAE has already introduced a 9% tax, which is going to be effective from 2023 June. And definitely there are certain conditions attached. Tax is mainly for the mainland LLC companies. Free zones are still out of purview of the corporate tax. So the notion UAE is a tax-free or no tax jurisdictions, it's going to be over very soon.
And Abhishek, your views on the Ireland route for the externalization?
Yeah, so I think again I'd make a more macro point, which is what I said at the beginning, right? Externalization should not be a quest to find the lowest tax jurisdiction and set up your base there, because by that logic you should go to a tax haven with a 0% tax rate. So that's not the perspective, because please bear in mind that the way the global tax world is going is that tax will have to now be paid where the substance and operations are and where the income is earned or where your customers are. A. B, there is already consensus and step towards a common rate of tax across the world. So chasing the lowest corporate tax rate is not going to really get you anywhere, because depending on where your operations are anyway, you'll end up paying tax in India to that extent. And that should not be the reason at all. So the reason we therefore are discussing the US in today's webinar over Ireland as an example is because there are other fundamental reasons to pick the US, whether it's the legal system around IPs, whether it is the larger customer base if you're a SaaS business, the larger pool of investors and things like that. Now that I'm aware, I have clients who have set up structures in Ireland because there were very specific reasons for them to do that. There was a particular founder base there. Two of their key critical customers were Irish customers to start with, and so on. So again, I just repeat, and I think this is a very important point for any founder listening in, that please do not chase the lowest corporate tax rate when you're looking at an external structure.
Also, I have a question here for Chander, like how difficult is it really to set up in the US? What are the nitty-gritties that goes into setting up? If you could explain us the process.
See, honestly, there are not much of a fuss that, you need to think about doing. Setting up of a company in the US is not very complex, unlike, we might probably find it sometimes in India. Commonly used route is Delaware LLCs. Just to test the waters for anyone, there are 2-3 forms of LLCs you can incorporate the entity with. There's a certain set of documentation. You need to maintain a local address. You need to pay your annual franchisee taxes on time. You need to, do your filings wherever it's mandatory. You need to maintain your book of accounts. And in case, you would want to be a locally taxed company in the US, then you need to be obliged with those regulations and, follow certain regulations. Or if you would want to convert into a corporation, like, then you need to maintain a whole set of documents and whole set of compliances to be done on an yearly, quarterly basis. And running of a business is not very complex again. It's a few things from an operational perspective. There's a process to do everything. To run the business, you need to have the company with subsequent tax IDs in place and then the bank account in place. So, there is a bit of time consumption in the, steps 2 and 3. And, as it's an openly accepted fact today, setting up of a company is not a challenge anywhere in the world as much as setting up a bank account is. The tremendous amount of compliance banks today have to go through, they always look at a perspective as to, what is it in for us, because the cost of compliance is so high. The regulations related to FATCA, CRS, although it's not applicable within the US, but when we look at other jurisdictions as well, Singapore, UAE, Netherlands, wherever you want to go and set up the base, setting up of banking, banking relationships is a bit of a more tedious task. You could set up a company in Singapore in one day, even in the US with an express incorporation. As a matter of fact, even in the UK. But setting up of bank accounts will start from taking your time of about 2 to 3 working weeks to going up to 6 months, and at times having no banking in place. So that is where it's more critical for anyone who intends to set up their companies overseas, be it a holding company, be it a wholly owned subsidiary, be it in the US or be it any other jurisdiction. There should be a proper business plan behind, or business rationale behind doing everything. And setting up of company to have investors in place, to have your contracts in place. Second thing that they need to really think of doing is how we go about a banking. So that is something that they also need to look into. But answering your question specifically, setting up of a US company, it's not a very complex task. You need to have your documentation in place. The application should be properly filed. You should, the local registry takes about 3 to 4 working days in normal working times. And depending upon certain complexities, during the COVID times, it was a little longer because of turnaround delays and so on. But now that, things are getting slowly back to normal, so the turnaround times have reduced. So yeah, so that's how the business works.
And Anil, how is it that you are incorporating companies outside India, and what do you think is a comparative analysis if we go to see why people are shifting their base from India? What is it that India lacks right now?
So the major reason what we have seen, or most of our clients goes overseas or outbound investment, is typically 2 reasons. First of all, if they are dealing with the international clients, or if they have international vendors, so making payments, still India is very stringent on the foreign exchange. If I have to send even $1,000 to overseas from Singapore bank or US bank, it's just a flip of coin. 2 minutes, the money will be out. But from India side, there is a 15 CACB, whole application go to AD. AD takes minimum 2 days. They again come back asking, there is no original invoice. Where is the stamp? All those things which delay everything. So making overseas payment, that is one of the reason. Second, if you are sourcing the business from overseas, that time if you have to invoice, GST has those provisions, that reverse charge mechanism. Sometimes Indian payment going overseas, you have to deduct the TDS. So overseas client, mostly even they don't understand what is the TDS, deducting the tax at the source. So in order to avoid those challenges, if you have only one overseas entity, Indian company having a subsidiary in US, or Indian company having a parent company in Singapore, that way they can keep their global business at that entity level, and the Indian business they can keep through only for the Indian customers. So that make their life easy. They don't get into a lot of litigation without reason. And the third thing is, it's very, very less headache, because most of the times what we have seen from most of our clients is they spend literally way more time on the compliances, attending the notices, rather than what they actually do the business development. So if one entity can take all the headache away.
Got it. And just circling back to Abhishek on the poem risk that we mentioned, I mean, it only applies when you're generating income, and startups, as you know, they're more loss making than income generating. And so really, I want to ask you if this poem risk is really a risk to be considered when it comes to startups going outside.
So it is, Radhika, just to clarify, it is the 50 crore threshold is a turnover threshold, not a profit threshold, right? So to that extent, even a startup which may not be making profit but is exceeding the 50 crore turnover threshold will be subject to the current or the new poem guidelines. So it is definitely something that is relevant. The only point is that one needs to understand the context of the relevance. Either it could be that all the income is taxed in India. Now, again, if there's no profit, that may not hold true, because India has its own rules on deductibility of different kinds of expenditures. So the moment you get subject to the Indian tax laws, then the whole computation needs to be done under the Indian laws. The other thing is that you expose yourself then to a lot of compliances. Technically, then all the payments that are being made by the US company ought to be complying with Indian withholding tax provisions and so on. So I would definitely say that unless you're in a situation where you don't have any income at all flowing through the US company, or the turnover is below 50 crores, in all other situations, poem is a real risk. or
Got
even
it.
if not a risk, a real aspect to be closely evaluated.
Yes. Understood. So Shantanu, coming to you, IP is considered as a really valuable asset. So how strong do you think is the legal enforcement of, contracts in the US when it comes to protecting your IP rights vis-a-vis India?
Yeah, I mean, I think we touched on it a little bit earlier. I think Divakar asked a similar question, but in general, I think the sanctity of contract is pretty strong in the US. I mean, the court system works and enforcement level is pretty high. So I think one of the other speakers mentioned that, in fact, people tend to be a little bit wary and a little bit, because of the US enforcement system, that they're a little cautious here in terms of the way they're doing business, because it is relatively easy to file a court case. And then the court case proceeds relatively quickly. And if you win, you can get enforcement action. So I think in general, it's pretty good here.
And how about the taxation process? How is it better in the USA?
I think, I don't know if it's, in terms of better or worse, but it's more, I think, efficient in some ways, because I think one of the things in India that some of the other panelists mentioned, it's not just the tax, the direct tax, but it's all these indirect taxes, the GSTs and TDSs and so many other things like that, which we just don't really have in the US. You have a federal tax and you have a state tax. We don't even have VAT, and so and maybe there's a sales tax depending on what you're selling, but in general it's fairly straightforward here. And I think the other point that people have mentioned is that the level of just, I don't know if scrutiny is the right word, but just in general the level of time and energy spent on compliance is just a lot less in the US. I mean, I find that one of the panelists mentioned, there's people clients spend more time on compliance than actually running their business. And that's not really the case in the US. In general, compliance is pretty straightforward here, and you can obviously hire professional advisors for that. But there isn't a continuous sort of cycle of harassment from the tax authorities. It just doesn't work that way here. Generally, it's pretty straightforward. I think in India, it's just particularly a lot of these new taxes, it seems to be very time consuming, and some of them may not even be well thought out. I mean, as I think Abhishek mentioned, they're meant to catch other people or other companies, but in fact they end up catching thousands of other companies, who end up in the same sort of justifying the premium or whatever it is, angel tax. I mean, these are really very controversial taxes.
Got it. And I had a question to all of you all in general, that at what stage should a startup really go for externalization? And can bootstrap startups register in the US? What are the costs involved in it? How cost efficient it is in terms of, the complications involved? Shantanu, starting with you.
Yeah, I can take that. I mean, in general, I would say that if a company has good reasons to do it, and it's not just because, I think one of the other panelists is because other companies have done it, but they have solid reasons why they want to do it. The good reasons would be, we have a US customer base, we have US investors, we plan to be a global company anyway. It's, I think Anil mentioned it's difficult to get money in and out of India. And so we don't have those problems in the US. There aren't really any exchange controls in the same way. And so for those reasons, if those are solid reasons to set up in the US. I mean, this is the world's largest economy still. And it's the world's largest investor base. I mean, we have trillions of dollars of investable capital here. So those are very good reasons to invest, to have a US company. And so even a younger company can relatively easily set up here in the US. So that makes a lot of sense. I would say that I see a lot of times companies try to push it off, and they kind of start out, the default option is, okay, fine, we'll just set up in India, which may work for some time, but over time it becomes more and more complicated. And I have dealt with a Series C company which flipped to the US. It was extremely complicated. It took six to 12 months and cost the company about $1 million in terms of fees. So it's, people shouldn't think that it's going to get easier. In fact, it gets more complicated from a tax angle. And then at the end, we actually ended up having a US parent company and an Indian sub, and some of the shareholders just could not come to the US level. There were just other complications, and so we ended up almost having a dual structure. So my advice is, if you have reasons to do it, then it's just easier to do it earlier than later.
Got it. And what has your experience been into this, Abhishek, since you deal with a lot of tech-based startups?
Yeah, again, I would echo what Shantanu said at the end, that sooner rather than later is the way to go. But again, it should not be that let me just do it because it's early. There should be a very clear analysis of why. And if that why is a yes now, then definitely the aspect of doing it faster works. But if the answer is no, it's not a closed door. It can be done later. Obviously, it gets more complex the longer you wait and the more value and the more operations you build into your business by then. But, so while speed is of essence, I don't think, again, speed or early stage should be the reason to flip if all the other factors don't stack up.
Understood. And this question to you both, Anil and Chandra, starting from Anil, what are the costs involved into setting up in the USA and how different is it from setting it up in the other jurisdictions?
Well, cost does vary. Someone charge $1,000, someone charge $10,000, or some online someone can go and do it into $50 also. So cost is different criteria because it depends on the firm and all other things. But coming back to how easy to set up US as compared to other jurisdiction is definitely it's much more easier, as Nakul mentioned. First of all, where we find difficulties or most of the startup struggle to set up the entity is quite a few jurisdictions like Singapore, India. One resident director is mandatory, which is the maximum cost. Suppose Singapore company cost you $7,000 to set up. So 3,500 minimum goes for the resident director for the first year. And every year it's a recurring cost. Whereas if you go few places like a UAE, quite a few GCC countries or African countries, minimum 51% local sponsor is mandatory, where again you need to pay because that partner is just for the sake over there. So they don't understand the technology business or life sciences business. They just want to take month on month their fees. So whereas you go for a US, first of all, no local resident director is mandatory, no local shareholder is mandatory. They allow corporate shareholder as well as individual shareholders. So they are very, very flexible when it comes to setup, very quick when it comes to setup, as Nakul mentioned, even if in one day, even few states, even you can incorporate company in 1 hour, paying the extra express fee. So that way, the US is little different, and that is the reason they are always in the top 5, top 10 by World Bank from doing the ease of business perspective.
Got it. Chandra, what's your view on this?
So, Radhika, just to go back to that point, can bootstrap startups, set up companies, and like what Abhishek and Shantanu emphasized on, it has to be purely intention. As a global services provider, we have dealt with companies having $0 of revenues to up to $10 billion of revenue, setting up companies across the globe. But it is completely driven by the intention and the business need. And, comparing costs sometimes becomes unjustifiable in certain situations because there are a lot of, factors that needs to be, gauged into business intention, strategy, where my investors are, what we have to do. Like Anil was mentioning briefly on the numbers, if I have to put in a number, one should really assume that, setup cost is one, second cost is running costs, minimum running cost for any structure to run. You can think of, setting up something and having a first year running cost of around $5,000, at least $5,000 to $6,000 minimum to run in the US. And it can go on a recurring basis for a dormant entity. It can go as as low as $3,000-4,000 to as high as $10,000 or $15,000. But again, what kind of operations you're having? The vis-a-vis in some place like a Singapore, it varies a little different. 7,000 to 8,000 you can expect in the first year, and going as high as 10,000-12,000 in the second year, and so on. Because some places you would need to get audited as well. Those costs are to be taken into picture. You need to have local reps, you need to have local directors, you need to have local office, you need to have local company secretaries, resident directors, cost of bookkeeping, running your operations over there, banking operations, transactions, a lot of things comes into play. So giving, just a cost of one thing, it's not like we're comparing, apple and banana. It's a little different in a way, but yeah, broadly given the whole scenario, these are some costs that you can always estimate.
Okay, so the choice of flip really depends on the founders, investors, or the regulators. I mean, I think it matters on where are you based. I mean, Shantanu, you mentioned that at CDC level it was very difficult, so I'm guessing it was the investors that chose to flip. Am I right?
Yeah, I think in that specific case, the company was raising a large round, and the business really was a global business, and so it made a lot more sense to flip it to the U.S. and investors largely drove that, and I think it was the right decision because they went on to raise a Series D and a Series E at a quite significant valuation, so it actually worked out quite well for them.
Okay. And Abhishek, from a regulator perspective, do you think in India the regulatory regime is very flexible for startups to continue for a longer run till they go for an IPO, or it's better for them to launch an IPO outside and hence flip?
Radhika, the answer would have been different 12 months back versus now, right? I think both markets are completely being routed as far as startup offerings are concerned. But again, I don't mean this to sound like a criticism of the Indian system, but I do think that there's still a long way to go in making it easier for Indian companies to list. I think the proposal to allow them to list directly on an overseas stock exchange is long overdue. The government talked about allowing that, but the regulatory changes and the tax changes have not been made. I think that is the one big thing that needs to be cleared in terms of the regulatory hurdles. The other things, of course, are nits and niggles, and those will continue, India being India. But I think the big one that can really solve this issue and solve for a lot of companies who perhaps externalize only with the desire that the US markets may give them a better valuation, considering that they're SaaS companies and so on, or more IP intensive companies. All of that can, or a large part of it can really be solved if India allows for direct overseas listing.
Understood. And Shantanu, yes, I think you have something to say.
Yeah, no, I was going to say, this conversation that we're having, I just wanted to point out that I've had these discussions at actual companies that have flipped not only from India, but from other jurisdictions as well. I mean, I've had Australian companies flip. I've had English companies flip, Swiss companies flip. And so this isn't only a unique phenomenon to India. And you could argue, those jurisdictions also work relatively well from a legal enforcement perspective. It's more about, in those cases, it was really about investor demand. And the fact is, those countries generally have much smaller venture capital ecosystems. And so if you want to attract US investors, which those companies did, it just made sense to set up something in the US and have the kind of the key founders or the C-suite executives move here. And I've seen this, as I said, in countries that you wouldn't necessarily think would have the same issues as India, but in fact, and they may not have the tax issues, et cetera, but it was just a lot easier for them to attract venture capital being a US company. And so it actually worked out quite well in these examples that I saw. Switzerland, UK, and Australian companies also flipped quite effectively to the US. They had less of the Indian issues in terms of RBI issues, et cetera. Like the Series C company I mentioned, it was quite complex. For an English company or Australian company, you could simply do a share swap, and it's relatively quick. It's much harder to do that.
Yeah, I was just going to ask you this question, that since you worked on transactions, I would like to know the methods of, implementing a flip transaction. Share swap is one of them. Have you seen any other structures taking place?
Yeah, I mean, certainly that's a topic probably for an entire another webinar, but it's, the easiest would be a share swap, a share exchange, we call it in the US. In fact, it can be a tax-free share exchange often, depending on the jurisdiction. So I've seen that done quite effectively with other jurisdictions. I think in the Indian context, it may be a little, it's more challenging, and I've not really seen it being done. I've seen, and some of the others can talk about the tax implications of that, because I think you need to get RBI permission to do a share swap, in which case it takes a long time and you may not get it. And so what I've seen people do is basically just try and replicate the cap table again in the US structure, and over time slowly move assets over. I mean, that's kind of the shorthand way of describing what I've typically seen in some of these other transactions. But that goes to the other point of trying to do it, earlier rather than later, because you're just increasing your cost and complexity. And I've also, in other examples, I've actually seen founders actually personally move out of India for the same reasons, that because they held a large amount of the shares in the very beginning of the company, for them to personally do this out of India was prohibitive. And so in several cases, I've seen founders move to Singapore, Dubai, and the US itself, really for the purposes of doing this. Otherwise, it would just have been impossible for them to to flip the company. I didn't see that happen in any of the other jurisdictions. Generally, they didn't really move because of regulatory reasons. They moved just because their customers were in Silicon Valley or wherever, and so that's why somebody would move from Australia to the US. But it wasn't because of a regulatory issue per se.
Got it. Abhishek, just one more thing on what Shantanu said, that on the taxation perspective in India, does RBI, restrict Indian participation into the foreign shares if a company, sets up abroad and has an Indian subsidiary? Is there some kind of restriction, or it's very flexible when it comes to dealing with such, entities?
I think there are 2 points here, Radhika. One is, a share swap also creates a tax incidence, because while India exempts mergers, it doesn't exempt share swaps, right? So that's an unfortunate situation. That's a problem even with domestic M&A done in the form of a swap, which today, as you can imagine, with everyone trying to conserve cash, a lot of M&As are actually happening in the form of swaps. So unfortunately, just having a simple structure where the US company buys out the existing Indian company and issues its own shares in consideration, while that would be a very logical way of doing it, most often that does not work with the tax considerations, because it creates a tax incidence without there being any realized liquidity for the shareholders. So nobody wants to pay tax without having made money. From an RBI perspective, again, you need a specific approval, because this would become a round trip structure to the extent you have residents sitting on the India cap table. RBI in general does not encourage or like round trip structures. There's also a draft circular floating around for about a year now, more than a year now, which basically says that as long as it's not for tax purposes, they will allow it. So at least to some extent, the draft seems to give some guidance in terms of how the RBI will look at these structures. But as we speak, today applications can take as long as 6 to 8 months. And even after that, there's no certainty or guarantee, and unless you make a very compelling case as to why you need an external structure, RBI in general does not approve share swaps.
Got it. I mean, we can have more questions around this, but we have a lot from the audience. So I'll let Devakar take some of the audience's questions.
So before we start with the audience questions, there's one other question I have is, how are the resident shareholders impacted, like for the company which are already in operation? So let's say a company raises significant amount of money from resident shareholders at the time of incorporation in India, then they do a Delaware flip. Shantanu was suggesting that typically what they do is replicate the structure there rather than do a share swap. So how does that impact the resident shareholders from India into those entities, both from the reporting requirements for the RBI and also when they eventually exit, because exit then happens typically in the US entity. So how does that impact resident shareholders? Abhishek, you can start with that.
Okay, sure. So, I think again, that's, a very detailed question in terms of how do you flip a resident from their shareholding at the India company into their shareholding at the US level, right? But from a reporting perspective, again, it all depends on how they've got it. If they've actually remitted money under LRS, then they can't hold more than 10%. ODI gets caught under round tripping, so that's not permitted. You still have sometimes people doing the gift structures. While there's no specific requirement to report it to the RBI, we strongly recommend the reporting is done so that there's no issue at the time of exit. You have sometimes a stock option thrown in. So I think it all depends on the facts. There's no one size fits all answer. And the reporting sort of follows depending on what format you've looked at or chosen to move the residents onto the US cap table.
Anil, you have anything further to add on that?
No, they covered almost everything.
So now we'll take some of the audience questions. One question which came, the first question is, I think we touched on externalization. Okay. There was a question from Mankoor Salim. In Dubai, they no longer require local national, like with 51% shareholding or reserve director manager. All the business revenues can be built there. How will POM be applicable in this case if the director are situated in India?
No, I can take that question. So first of all, that information is not precise, is that there is no longer 51% sponsor is required. So only to just boost the inbound investment, UAE government has come to a resolution that certain activities, there are very minimal activities where local sponsor is not required. As you know, Dubai has two types of entities. One is LLC, which is a mainland entity where 51% foreign ownership is, 49% foreign ownership is only allowed. And another is free zone companies where 100% foreign ownership is allowed. So very few sectors that has been waived up. Otherwise, almost 90% cases, local sponsor is must.
Another question is, there's a series of couple of questions in that. One, if an Indian founder set up a company in the US, can they make subsidiaries under that company? As someone suggested to them that if you set up a company in the UK and then that company can make further subsidiaries, but a US company can't. Is that true, Shantanu?
I don't see that. I mean, there's no US law that would prohibit it. I think what they're talking about is around the round tripping issue where an Indian, has a problem, Indian resident setting up a US company, that company then can't have a step down subsidiary. I think that's what they're talking about. But I think that's generally for outside of India completely and not just US versus UK. I don't see how setting up a US company, a UK company would get around that rule.
Just to add to this, onto this point. So basically, the question could have been, if I set up a US entity, because the mindset is, that I have set up the US entity via which route from RBI approval, whether it's under LRS or ODI, LRS, ODI, can I have a step down or not? So if it's under the ODI regulations, so you can always have a step down subsidiary. So that I think that would answer the question in a simplistic term. If it's too technical, maybe Abhishek would be the right person to answer on this.
But I don't see a founder using the ODI route. That would be a company using the ODI.
Yeah.
Okay. Next question is, can an Indian company acquire shares in the US Delaware company against asset purchase of Indian digital assets? Shantanu, would you like to take that?
Well, I mean, I think you're doing some kind of a swap. I guess that's what they're talking about. I mean, you can, under US law, certainly the consideration can be in any form. Whatever the board of directors decide is correct consideration. So there's no rule that, I mean, I've had clients ask me, can we buy shares using crypto? And the answer is yes. In the US, there isn't any prohibition on using any form of consideration. So whatever the form of consideration, the question really is from the India side, whether you can contribute assets and that would create any tax liabilities or other issues in India. But on the US side, there really isn't any prohibition. What is considered consideration, it just has to be, consideration, but whether in any form, but as long as the board of directors use it sufficient, that's enough.
So I think the question was more targeted towards an Indian company basically buying a share in the US Delaware and then using, instead of paying cash, they are basically passing the assets over or the IPs that they may hold in India against that. So that's probably the question that they were looking to answer.
You need an RBI approval for that.
You need an approval from RBI.
Yeah.
Okay. All right. Okay, the follow-on question on that UAE question was, the question was more in the context of sector where it is waived off. How will POEM be applicable then if the directors are in India? Anil, if you can take that.
POEM is crystal clear, as Abhishek sir mentioned a couple of times, unless you touch that 15 crore as a turnover and all other things. But if you really deep down, POEM is a subject in itself to study in which case it will be applicable and in which case it will not be applicable.
Okay, and we are coming into time, but one final question is, what if an Indian private limited company owns a UK company that further US company to bypass Indian founders' restrictions on making subsidiaries? Is this a good structure, and will RBI approval will be required in that case?
So maybe I can try. I don't see how that's circumventing the restriction that apply to founders. And I would just tell you that all of RBI's rules in substance and in form are smarter than anyone can come up with structures. So don't try and circumvent any rules. But I don't see how this structure is solving any problem. because a founder cannot set up under ODI, you can't set up a subsidiary outside India, which has any subsidiary back in India. So, or for that matter, actually any subsidiary anywhere in the world. So by doing a two-tier structure, you're not solving for that.
Right.
So I think we've covered most of the questions, and it's already time to know how it flew by. And like Shantanu mentioned, some of the topics were actually, deep dive topics, which will take hours and hours of discussion. So we'll have a follow on to that. But just before we close, I just wanted to tell our audience, thanks a lot for your time. And we do actually help startups in externalization. So if you all have any queries with respect to that or fundraise, which we anyways help in by connecting with global investors, do reach out to us. And just want to thank Anil, Chandra, Shantanu, Abhishek for your time. Abhishek, you are in a retreat, so thanks a lot for taking time out from there. And Shantanu, it's morning for you, so hope you have a good day ahead. Chandra and Anil, very insightful discussion with you on how you have done it in your experience with the clients. So thanks a lot. And yeah, we can soon have a follow-on session with that. So we'll keep you all updated on our LinkedIn.
All right, thank you.
Thank you.
Thank you. Thank you, everyone.
Thank
Bye.
you. Good evening, everyone. Bye-bye.